Well, it's really good to be back. I wasn't here last year, but some of you may have seen me talk in 22 and 23, and in which case you will recognize this slide, because I used it on both occasions. I've talked quite a lot about hypermixity being the new normal in real estate. And what I want to do today is actually make the case for hypermixity, talk about why it's needed, what it is, what the problem is with single-use assets, and the role of real estate more broadly in the 21st century. So what do I mean by hypermixity? Well, being an academic, I had the luxury of being able to go back over very long data sets. I like to delve back into history, but this is perhaps a little extreme. 15,000 years ago, give or take, the first humans started to use the site that is now Jericho, the world's oldest city, probably for some kind of something that probably looked more like a festival, worshipping of a moon goddess on the banks of the River Jordan. But we kind of forget that at the heart of real estate and real estate value is the gathering of human beings into what we call cities or settlements. And the point is here, this is a human condition. It predates even agriculture when these first cities started to be used by hunter-gatherers. You can see the same sort of thing happening. This is Glastonbury after the festival. You can see that people have that festival created a mini city with sort of main streets, side streets, and back streets, and so on. And the point is that all human activity, certainly the basis of civilization, takes place in these cities. When human beings gather, we do all kinds of things, and this is by no means an exhaustive list. Fast forwarding to the noughties, I have used this slide repeatedly and intentionally. It's a piece of work I did for a client back in about 2007, I think, where we were looking. We were talking just now about the productivity. What we were interested in was the productivity of places. And working for the big sort of regeneration companies, people looking at, well, it's been variously new towns, eco-towns, garden cities and so forth, but actually trying to understand what makes a good place involved us just simply looking at good existing places, socially successful, economically successful, established places, and finding all kinds of stuff that doesn't fit into standard asset classes. So real valuable places are fine-grained, varied, and messy, and that, back into history, has been the case. This is the Via Domitia in Narbonne in southwest France. What I love is that even though the old Roman pavement, as it were, is a couple of meters below the existing street, that street persists. It is lined with cafes and shops, probably in a very similar way to how it was 2,000 years ago when the Romans were traversing that street. It also is something that's universal. People understand, and I don't want to romanticize poverty, but this kind of street is well recognized. This is Derby in Mumbai. It happens to be one of the most productive bits of city. And for a lot of people, we talk about global urbanization. For a lot of people, these squatted settlements, these self-made settlements, are what is meant by global urbanization. This is a fascinating book, all sorts of interesting insights in it by Robert Newirth, but he's saying 1 billion people will be living in these type of self-made settlements by 2050. So we're coming from a very long human history of cities that are hypermixed, where all human activity takes place. And what we've created in the last few decades is a very different type of real estate, dominated by single-use assets. And I want to delve into that and talk a bit more about what the problem might be. The first thing to say is that the late 20th century was a weird period in history. It shaped global cities, but it was peculiar. And even now, conditions have changed. We've started talking about some of those conditions, I think, today. I propose that the 21st century, or the rest of it, will be different. So what was it about the 20th century that made it peculiar? Well, we can start with the Great Inflation. Interest rates were high, and consequently, payback period short, there was an inbuilt short-termism. High inflation also created money illusion, and so that is effectively that debt was devalued by inflation. So it's highly favourable to take on debt. Gearing seemed natural, normal. Another thing which, though the inflationary sort of impacts of on real estate might have been thought about, I think not considered enough is the period we've just been through since the 1990s of this incredible downward yield shift. We've just heard about the sort of decoupling of bond markets from Bank of England base rates. The Bank of England base rates peaked at 17%, went down obviously during QE and COVID to 0.25. That yield shift was enough to create probably half the house price growth we've seen in the West over the last 30 years or so. We've got used to the automatic asset price inflation, and I'm not just talking about real estate assets. Equities and, of course, bond markets also saw that asset price growth. So there was an automatic capital return, as it were, available during the 20th century. And finally, we can't ignore demographics in this. The baby boomer generation saving money, depositing with big institutions, meant that the name of the game for those big institutions was lumpy investment for capital growth. I suggest that led to a very, of course, all of us in this room were trained during this period. The norms and the conventions of the real estate industry is based in this period. But we think that it's quite normal to acquire big buildings in single uses, pre-AI, so that they could be managed according to modern portfolio theory. Big car-dominated grids, a whole load of sort of other infrastructure and social things going on there. But effectively, the money in real estate used to be made out of the serial trading of land, or land and property. So the name of the game was capital growth, big lumpy investments for capital growth, a lot of emphasis on the capital transactions sort of side of real estate. It had the power and the money trading at ever-increasing values. But I will show how I think that's changed in future. But what I do want to show is how, if you like, form followed finance, followed the financial conditions, and was kind of enabled by all sorts of land use and land economy theory. And I just want to point out that the sort of theories that have been shaping our cities in these single uses actually had their foundations as long ago as 1826, when von Thünen was trying to sort of work out how land values work and trying to simplify, if you like, a very complex thing. This was then taken up in the early 20th century by Park and Burgess with their concentric ring theory, and most of you who studied real estate or land economy will recognize the sort of bid-rent curve, this idea that rents change for different uses as you get away from the city centre, and this is really, as it were, the foundation of zoning or use classes, these highly simplified, sort of reductive uses. Nevertheless, whole swathes of cities, not least in China, have been built on these sort of models. What started off as a theoretical sort of explainer has actually become, if you like, the reality, and enabled that deployment of capital in big lumps, big buildings, single uses, zoned. I can see I have slight qualms about showing you the next slide because it seems the text has all gone haywire. But all I wanted to show here is that what we call, it's not just buildings that have been sort of highly segmented and zoned, if you like, the whole industry, what we call the property cycle. Is actually anything but a cycle. It's actually a sort of linear process where we start with land acquisition, pre-planning, advice, design and scoping, planning and engagement, construction, operation, demolition. Why do I put this up here? Well, I think as I say, it's not a cycle. It can be summarized perhaps as sort of design it and go away, build it and bugger off, and then use it and throw it away. We don't join the two ends, but each sort of element of the development and landowning process is highly siloed and specialised, and it's quite rare for people in these different sort of sectors to talk to each other. Why is that then a problem, these single uses? Well, I think what we have already seen and perhaps will increasingly see is quite simply the problem of obsolescence. So this is a shopping centre, the Wheat Sheaf in Rochdale, and finally abandoned after COVID. But we're all familiar now with so how the retail demand has shifted with the rise of e-tailing and so forth. And maybe if we got out of that sector and into operational real estate or some new sector, we're patting ourselves on the back. A lot of people were patting themselves on the back for getting out of retail and into offices, and then COVID hit and maybe they weren't feeling quite so smug after that. And we all know how demand for the workplace has changed and is changing. We're faced with constantly shifting demand. And of course, we're all aware that talk has already been about AI and technology, how the new technological world is continuing to shift that. Also, I think we have to talk about depreciation. And I thank Neil Hudson at Built Place and fully acknowledge him for this graph. I've produced similar ones in the past myself. But if you look at how newly built properties, particularly flats, perform over time, you see a very quick loss of the new build premium, which can be as much as 20% as the years go on from the point of sale. And particularly in the case of flats, we're seeing a lot of underperformance. So this is, as it were, performance in relation to the local market. I think this is something that is increasingly going to face build-to-rent investors. Single-use apartments, whether they be luxury or otherwise, are expensive machines for living in, to misquote Corbusier. And the ongoing costs of maintenance and upkeep are proving quite high. a lot of housing associations are already avoiding apartments and preferring single-family homes when they're considering new stock, simply because of the cost of maintenance and upkeep, which puts our operations absolutely front and centre. And I think all this starts to force us to refocus, and I think it's essential to refocus and rethink about what real estate actually is. We can go to the extreme here. We've already heard something about Japan. That's a place where obsolescence, the changing demographics, the aging population in Japan has changed demand for housing. We've got the added problems of earthquakes here actually creating devaluing assets. And maybe, we may not be looking at earthquakes, but we're certainly looking at increased floods, fires and so forth as a result of climate change. Potentially destroying assets. The reason I put it here is because, and I talk about depreciation in the context of Japan, is because Japan is very cognizant and always has been, probably because of the earthquake problem, of a difference between the value of buildings and the value of land. Buildings are automatically depreciated in Japan. It's something you can set against your taxes to land value. And land value is seen as something separate. And I think we're going to have to start considering that. Talking of demographics, I also wanted to show this chart showing how demand can seem to change very quickly. We've already talked about death quite openly, so I will say this is my modelling of the death rate and the impact of the death rate in the UK as we become an age-ed rather than ageing population. And what this chart shows is quite simply the surplus in the second-hand stock compared to the previous norm. So what I'm comparing is new household formation, including immigration, continuing at high rates. You've got increasing demand, yes, or continued demand from new household formation for housing, but coming onto the market and being made vacant or available in all sectors, an increasing number of homes are vacated by the elderly or deceased. So my calculations are that as pretty much of next year, we end up in a position where we start to see a surplus of homes, not a shortage, and it does rather call into question the 1.5 million targets. And when we're talking about demand, that's for housing. We can also talk about demand for cities themselves, if you like. And if we look, at the highest of sort of the new industries, the tech industries, and the demand for what people want in those industries, this is taken from Savills survey of tech cities. We can see that things like city buzz and wellness are as important in, as it were, the real estate offering as the actual workplace itself. So what we're seeing is that even in the world of tech, where and perhaps especially in the world of tech, where you can do anything anywhere and everything everywhere with a handheld device, what starts to matter is those factors that first attracted people in those very early cities, the face-to-face meetings and encounters and relationships formed in a place with other human beings. And that seems to be what's most valued by the very globally footloose tech talent that we're seeing in cities at the moment. So, what is the role of real estate in the 21st century? Well, the change is that in the 21st century, we're in an era of low interest rates, probably back to something like the 250 years that preceded the Second World War. That means long payback periods. That means long-term holdings, in my view. low inflation means that you have to add value. Inflation isn't going to just inflate your rents for you. It's very much about value add. The emphasis is on cash flows because the baby boomers are now aged and those big institutions need to pay the pensions. There can be no more yield shift if interest rates pretty much bottomed out. So there can be no capital growth without rental growth. So the emphasis on revenue really matters. And creating cash flow, as I say, to pay pensions. So the emphasis is on net operating income. And you see NOI written so much more than I ever used to. So what does that mean? In terms of what our cities look like, fine complex grids, simple buildings, complex uses, some people call it long life, loose fit, holding land stewardship, operational real estate really comes to the fore because it's all about those net income streams. I think we need to rethink what are both global planning or zoning and global asset classes away from this very reductive sort of 5 sectors and think much more about that human activity. I wanted very quickly, if I may, to sort of say inside of a changing global order. You could say, well, we always knew the US would never, the US century, as it were, the 20th century would never last. Here's China coming up the ranks. This is a very long run, sort of going back to 1500, showing who's top nation at any one time, so who's taken that sort of global hegemony on. It looks, for various technical reasons which I can't go into, that China, though it will be massive economically and in trading terms, probably won't become the single global hegemon. I suspect we're looking much more to a multipolar world order. Some people say that will mean sort of endless conflicts and disruption. Others, perhaps something more equitable. But what we do know is that in those uncertain times, gold, physical gold, as opposed to other forms of gold holdings, has soared. It's hardly surprising, that we've got near record gold prices right now. And I think, well, that's natural for gold. I think we in real estate also need to think about, well, what does real estate offer in these uncertain terms? It is, give or take the odd trillion, at 380 trillion, way bigger sort of asset than the mere 12.2 trillion of all gold ever mined. So, real estate, I think being land has some of those characteristics of gold. It's income-producing gold, if you like. So I think we need to get away from these sort of 19th century sort of notions of the means of production, where all the emphasis of our studies has been on capital, a little bit on labour, and very, very little on understanding land. And actually broaden the definitions, certainly of people, away from just being pure labour, thinking about money generally, and thinking of real assets, real estate, being immovable, i.e. based on land. And I would suggest to you that the value of real estate is created and destroyed in the interactions between these things, and the millions of interactions, different interactions. Fundamentally, the shelter or the stability, the literally one standing on land, then giving rise to our productivity, the capability of people to generate wealth and income, and then reinvest back in the land, and the cycle goes on. You'll see, you can also interpose sustainability, and increasingly, I think sustainability and wealth, if you like, will be seen as the same thing. So it's in the middle of all this that things really matter. So real estate value is determined by governance in its broadest sense. It's what happens in the middle there that's so important. This is why I would argue all real estate is operational. It's never been more important to understand how to add value, how to create that place productivity, if you like, to generate wealth and growth. So the future of real estate is I think, quite positive. It's different to other assets. I think we'll increasingly see real estate re-establishing itself as a diversifier. It's potentially a safe haven in the right jurisdictions with the right currencies that aren't devaluing. It will be seen, I think, increasingly by global capital as a safe haven. Income producing, though, value increasingly explicitly being derived from net income streams. Rule of law and security will matter hugely. The fact is adaptable and operational and long-term matters in this new world. So, hypermixity is the new normal. I'm going to move away from Florence, which I've been showing for years now, to Barcelona and some interiors, just to give you an idea of the sort of thing I mean. The hypermixity means actually managing space to optimize income, to understand people, to understand your customer, to enable all those human activities to take place, whether it's theatres or rooftop bars or leisure facilities or just flexible space that can be used for weddings or business meetings or whatever. What it means is actually, and I deliberately use this hotel because it has this lovely, in the co-working space, has this lovely sign, change makers welcome. I think it actually ought to be change makers essential. And you, in the operations sort of sector of real estate, really understand the components that are going to drive real estate value going forward. So hopefully might have time for a few questions. I know I've overrun.